Hey everyone, and welcome back to Gold Off the Charts. In a market full of noise, mind games, and uncertainty, we don't just watch the surface level action, we look at the real mechanics driving the trends. A bit of deep financial insight every day will help you see further, trade steadier, and outlast the crowd on your journey to building wealth. If you've been watching the gold and silver markets over the last 24 hours, you've definitely been on a wild roller coaster ride from hell to heaven. These two assets were practically in the ICU a few days ago, but now they're not just alive, they're dancing. This rebound has been absolutely jaw-dropping. Gold isn't just bouncing back, it has surged back above the $5,000 mark. On February 3rd alone, spot gold skyrocketed by over 6%. Think about that, a 6% move in a single day? To put that in perspective, this is the biggest one-day jump since the 2008 financial crisis. We are witnessing a spectacle that hasn't been seen in 16 years, and it's happening right in front of us. Today, that momentum is holding steady. Silver didn't want to be left behind either, jumping nearly 10% to get back near $87 per ounce. This massive big white candle basically wiped out last Friday's brutal 27% crash and Monday's scary 6% drop. It was like falling off a cliff, only to grab a branch midair and get launched back to the peak by a rocket. Faced with this insanity, I know you probably have one big question. Is this just a temporary bounce? Or is the bull market officially back on? With gold hitting a 16-year daily high, is it time to dive back in and grab the bag? Today, I'm going to break down the truth behind this crash and burn recovery. We need to figure out if the danger has passed, or more importantly, if gold still has a shot at hitting that dream target of $6,000 in the coming days. First, let's be clear. This price surge didn't happen by magic, and it wasn't just some market maker drawing lines on a chart. It's a natural reaction as the market digests recent volatility. It's what we call a retaliatory rally after a period of extreme panic. Many of you might be wondering why the rebound was so violent. Well, while we were watching the gold charts, something huge happened on a different battlefield, the tech world. This event was the fuse that lit this epic rebound, and it's our first focus today. The tech stock sell-off is becoming the new fuel for the precious metals bull market. It's a massive shift in capital. The epicenter of this shakeup wasn't Wall Street. It was the labs of Silicon Valley. Recently, the AI giant Anthropic released a new automation tool. Normally, this would be seen as great progress, a huge leap for human productivity. But for the stock market, it turned into a horror story. Why? Because it triggered a deep fear that existing business models are about to be completely flipped upside down. Investors are starting to worry. Is AI moving too fast? Will it kill the profits of current software companies? Will the tech giants lose their competitive moats overnight? If AI can code, design, and automate everything, what's left for software companies that charge per user or per license? This led to massive panic selling. The tech sector, especially software, saw its biggest capital flight since April of last year. All three major U.S. indexes took a hit. The S&P 500 dropped 1.6%, the tech-heavy NASDAQ fell about 2.4%, and the NASDAQ 100 slid over 2%. Even the Dow fell nearly 1.2%. Think about it. When money runs away from these expensive tech stocks, where do those billions of dollars go? They don't just vanish, they move. They float into small-cap stocks, value stocks, and our main star gold. When tech is no longer a safe haven and the AI story turns from a dream into a nightmare, and when future profits become hard to predict, gold, a hard asset that's been trusted for thousands of years, becomes the perfect place to hide. This is a classic rotation of capital between asset classes, and it's a powerful boost for gold. In this environment of short tech, long gold, we saw gold and silver make their JEDI counterattack. So the next question is, will it last? To answer that, we have to look at why gold crashed in the first place. Think back to last week's roller coaster. What caused the drop? As we discussed, it mostly came down to the change in leadership at the Federal Reserve. Trump nominated Kevin Warsh to replace Jerome Powell this May. This news was like dropping a bomb into a quiet lake. Warsh is known on Wall Street as a hawk. He's very aggressive when it comes to fighting inflation and managing the Fed's balance sheet. He once wrote that the Fed's massive assets were distorting the system and called for a major tapering or reduction of those holdings. This panicked the market. People feared the Fed would pull back liquidity while trying to cut rates, like hitting the gas and the brake at the same time. This also led to higher margin requirements for futures trading, which forced gold prices down. However, the market always tries to correct itself. Tuesday's rally showed that investors have calmed down. People realized the panic might have been overkill. Yes, Warsh is a hawk, but would he really risk crashing a fragile economy? As a result, dip buyers swarmed in like sharks smelling blood. This shows the market has moved from blind panic back to logic, and gold's appeal as a safe haven is back in the spotlight. There is also a side story: the brief U.S. government shutdown. It only lasted 4 days, but it delayed the release of the January jobs report. For the markets, no data means more uncertainty. When people have to guess, they get nervous, and uncertainty is gold's best friend. This drove up safe haven demand even further. Now that the government is back open, we need to watch for the new release date of that data, as it could be the next big market mover. Now, let's look at how the Fed's policy shift impacts gold. This is the core macro factor you need to understand. While the market doesn't expect Warsh to rush into rate cuts, his focus on shrinking the balance sheet could change the yield curve. This creates both risks and opportunities for gold. Comments from Richmond Fed President Barkin on Tuesday seem to back this up. He noted that rate cuts help the job market stay healthy, while better productivity helps keep costs down for companies. This helps inflation get back to that 2% target. It sounds like typical Fed speak, but it shows they are being very cautious. However, Barkin also admitted that the future is unpredictable, which keeps the door open for more market volatility. Meanwhile, Fed Governor Adriana Kugler has been out defending the idea of aggressive rate cuts this year. This is a very interesting divide. On one hand, you have the incoming hawk Warsh. On the other, you have the current dove Kugler. These two views are clashing in the market. This wait-and-see atmosphere usually drives investors toward the safest asset available, gold. At the same time, U.S. manufacturing data looked good. The PMI hit 52.6 last month, a high since August 2022. Usually, strong economic data makes the U.S. dollar stronger. But strangely, the dollar index actually fell on Tuesday, ending a recent winning streak. Why is that? Analysts at State Street believe there's an anti-dollar sentiment brewing. Essentially, people like the U.S. economy, but they're losing faith in the currency itself. This makes gold look much better than the dollar as a place to park money. Treasury yields also dropped. The 2-year and 10-year rates both ticked down. This reflects a bet that the Fed will eventually have to shift. Lower yields make gold more attractive because gold doesn't pay interest. When interest rates are low, gold shines brighter. While rate cut expectations have moved to June, a weak job market could move that timeline up. If that happens, gold has even more room to run. We also can't forget that gold thrives during geopolitical tension. Recent events prove this. Russia launched attacks on Ukraine's energy grid right before a new round of peace talks. This left cities like Kyiv without heat, broke energy ceasefire agreements, and set records for missile launches. Even though the U.S. made progress with India and Iran, the sudden escalation in Ukraine is what's really driving the market mood. Traders always react more strongly to bad news than good news. Plus, even though the U.S. government shutdown ended quickly, with Trump signing a bill to fund defense and healthcare through February 13th, the event exposed how divided U.S. politics really are. Democrats are already pushing back on immigration policies, signaling more fighting ahead. When a superpower is divided, people question its currency and its credit. This is a long-term win for gold. The stock market sell-off also forced people into the safety of government bonds. As economist Thomas Simons noted, the usual market patterns are breaking down, making it hard to judge risk right now, but gold's volatility reflects this confusion. With the Australian dollar jumping on inflation news and the yen reacting to elections, the US dollar's dominance is fading, giving gold a boost. Now, let's see what the big money on Wall Street, the firms managing trillions, actually think about this gold earthquake. Giants like Barclays, UBS, and Deutsche Bank are surprisingly calm. They don't see this as the end of the bull market, they see it as a healthy cleanup. They believe the big picture story hasn't changed, and gold is still on track for $6,000. Look at the latest UBS report. They asked the question everyone's thinking, is the gold rally over? Their answer was a flat no. UBS says the 21% drop from the highs was just a purge of short-term speculators. The market had become too crowded with people chasing the trend. When everyone tries to take profits at the same time, you get a stampede effect. UBS thinks this reset was actually necessary. In the long run, this pullback is a good thing. It gives smart investors a chance to enter at much better prices. They expect strong support to hold near these levels. Retail traders see a crash, institutions see a sale. Barclays agrees. Their models show gold's fair value is around $4,000. Even though gold is trading higher than that, the pullback to $4,900 brings it back into a more reasonable range. More importantly, they noted, when politics are messy and paper money loses credibility, gold trading above fair value isn't a bubble, it's the market pricing in future risks. This is a key point. People are willing to pay a premium for gold because it's insurance against a currency collapse. Beyond Wall Street, there is a massive wave of buying coming from the East specifically, from China We know central banks have been buying gold for years, but now China's private investors are waking up. Deutsche Bank shared a shocking stat. Chinese investors are buying gold ETFs at 3 times the rate they did last year. That's a 300% increase! While Western speculators might be selling their futures contracts, Eastern investors are scooping up the physical gold through ETFs. This is a shift in who owns the wealth and who controls the price. For Chinese buyers, gold isn't just for jewelry anymore. It's now a key part of their investment strategy to protect against a weaker yuan and global instability. This demand is steady and strong, creating a solid floor under the gold price. So, let's summarize. On one hand, the AI tech shock is pushing money out of software stocks. That money is looking for a safe home, and gold is the top choice. On the other hand, Wall Street sees this dip as a healthy correction in a bull market. On top of that, Chinese buyers are aggressively buying the dip. These 3 forces together give us a clear signal. The gold bull market is far from over. The fundamentals, Fed policy, geopolitics, and a weaker dollar are all still in play. With economic data delayed and global uncertainty rising, gold's safe haven status will only shine brighter. The logic of the market is shifting. It's no longer just about interest rates. It's about hedging against uncertainty and technological disruption. Gold's value is being redefined for a new era. The rebound of the last 2 days shows that the bulls are very much alive and well. The people who sold in a panic during the crash just handed their gold over to more disciplined, long-term investors. That's the brutal reality of the market. So, what should you do? The most important thing for regular investors is to stay level-headed. Don't let short-term swings scare you. But don't get overexcited when the price jumps either. Look at the big picture. The decline of paper currency, global debt, and geopolitical chaos. None of these problems have been fixed. In fact, many are getting worse. As long as they exist, gold will have a reason to go higher. Finally, I want to hear from you. After this crazy roller coaster ride, how are you feeling about the market? Do you think gold is going straight to $6,000, or will it stay stuck around $5,000 for a while? Are you still holding your positions? Are you planning to buy more? Or are you sitting on the sidelines? Let me know your thoughts and your plan in the comments below. Just a quick reminder, this analysis is my personal view based on market logic. It is not financial advice. Investing involves risk. Always do your own research and make choices based on your own risk tolerance. If this video helped you make sense of the market, please hit the like button and subscribe. Share this with anyone else who might be confused by these wild moves. This is Gold Off the Charts. See you in the next one.